America leads the world in medicine development. It matters. We get new medicines first, nearly 3 years faster. 5 million Americans go to work because we make medicines here at home. And not relying on other countries keeps us safe. But China is racing to overtake us. Will we let them, or will we choose to stay ahead? When America leads, America cures. Let's tell Washington to keep us in the lead.
Learn how at americacures.com. Paid for by Pharma.
Reality radio for a really great future. We're talking real money.
How low can they go? How low can they go? How low can they go? How low can fees go? Who's the lowest fee mutual fund and ETF company in the world? You know the answer. Vanguard. Their fees are ridiculously low. So what is Vanguard doing this month? What did they do this month? Well, they lowered the fees again on like a quarter of their funds, and now their average fee at Vanguard, their average fee across their managed and their index funds is 0.06 or 6 basis points. That is 6 cents on every $100 invested. Wow.
You imagine what other people in the industry that are trying to run exchange-traded funds must think of them. Must hate them because, like, wait, God, we're not going to make any money.
How can we make money at 6 cents on 100? Hi, everybody. Welcome to Talking Real Money, the podcast, where we talk about, guess what? I want you to guess. You guessed on the Vanguard thing. What do we talk about on Talking Real Money?
Soccer?
There's a hint. It's in the name.
Aviation?
We talk about money.
World War II?
We do that sometimes when the mood strikes you. We definitely talk about aircraft for some strange reason from time to time.
Oh, it's Seattle. Big aircraft place.
No, it's the Model Military Museum.
You haven't said those words in a long time.
Well, because the Model Military Museum does not have the same impact in your new house that it did in your old house.
You know what? Here's the thing. You just haven't looked very carefully because now it's almost as many planes up as I used to have.
Yeah, but it used to be more in my vision. It was like there
I'll
were
make
planes
sure for the next radio show
that filled my field of view.
You'll see.
And they don't anymore. So I can't sit here going, gee, I wonder what that
Can you name
aircraft
one
is.
of the planes?
I can name like probably 6 of them.
Okay.
You probably have a B-17.
Yeah, okay, you got that one right.
Oh, pretty good one, huh?
Yeah.
I do remember you have a cargo plane. I'm trying to remember what it's a C designation.
Okay,
but,
yeah, that's right.
Yeah,
C-130. Yeah.
C-130. I was trying to remember the number.
Big plane, yeah.
I know you have a U-2.
Yep.
Yeah.
Not the band.
Not the band. No, not the band.
Okay, there's 2 obvious ones because my old man flew them. B-24.
B-24. I was getting
P-61.
there.
P-61.
I didn't know he flew a P-61.
Well, that was the plane he got trained in and was hoping to fly, but they stuck him in the freight train of the skies.
You have some World War II fighters on both sides. You have some float planes. You've got
that's right. You're doing pretty well.
You've got a B-1.
Yeah, that's out in the garage because I don't have enough room in the new office.
Yeah, well, the B-1 is huge. To scale, it dwarfs all the other planes.
Yes, it does. It's very large.
You don't have a B-52.
There's no
that would
such
be
thing
big
in 1
too.
to 48 scale of B-52. They couldn't make it. It's too big.
You could actually put real engines on it and fly it.
Probably with both of us inside.
All right. So now, do you see what just happened to the podcast?
Yeah, I'm sorry. I do apologize. Okay. We want to talk about money, right? That's what you.
I don't know anymore.
No,
I'm sorry. I don't remember.
Yeah. There's a
Were you talking about fees?
Yeah.
Vanguard's fees, the lowest in the industry, got lower.
Yeah, and the thing is, we'll just be right up front. When we saw the story, Don said, not a good story, not interesting. And I said,
interesting.
Because it is for the following reason.
All right.
Because, first of all, step back. Let's just talk about fees in a general sense.
All right, I'm going to step back.
Okay, you're one more step, you're going to be right down the stairs. Because so many of you are paying fees you don't know you're paying. We had a call a couple weeks ago, month ago, 2 months ago, whatever it was, from a woman who, remember, the fund expense was 2, and she was also paying the advisor like 1.75. So remember, if you're having somebody help you with your money, you're paying them to do that. Then there's the underlying assets they invest you in. That's the part we're talking about today. This does not include commissions, by the way, which some of you are still paying. This is the expense of the underlying assets. And we recommend using, as you know, exchange-traded funds or mutual funds because they're baskets. They give you professional management, diversification, et cetera. And Vanguard, yes, they say they're going to save $250 million by reducing these fees, and their fees are very, very low. But they're not alone in this industry. And there's a lot of funds that are just outrageously expensive. For example, and I'm pretty sure you're not in this one, Don, the Militia long-short equity ETF.
Wait a minute.
Great branding. I like it too, by the way.
Is this a popular fund in Idaho and Grants Pass, Oregon?
Ooh, you're going to get in trouble for those. I'll tell you right now. No,
Wait a
but
minute.
their assets are marching in, they say, on a regular basis. It's
What's
ORR.
The name of it?
ORR is the ticker.
It's an ETF.
ETF. Yep. The long-short equity ETF, their expense ratio is 14.19. Now, that's a little on the high side.
Wait. A little?
When Vanguard's only requiring you to pay 0.06. So that's
fund. Wait, hold on. No, do not just gloss over this.
I didn't look into the fund itself other than the fee.
But let's just talk about that fee for a moment. To give you a 0% annual return, they have to have an internal rate of return for their investments of about 15%.
That's right. You got to have a good year.
Every year.
That's right.
Otherwise, if they just make 10%, in 20 years, all your money is gone.
Well, it wouldn't be all, but it'd get pretty small at the end. So let's just put it that way.
Most of it. What do they do with their money?
I don't know. You can look into that one. But how about BIZD? BIZD, the VanEck BDC income ETF, where they only charge 12.86% a year.
BIZD?
BIZD, the VanEck BDC.
Okay, that's an income fund.
Yeah, right. Yeah.
So 12.86%, and
that's right.
They invest in. Oh, we talked about this in a previous podcast. In fact, the last one, these alternative lending vehicles.
Oh, so that's where we're
what
headed
they
here?
have. Blue Owl is one of their biggest holdings.
Of course, a private lender. Yep.
They're private lenders. Oh my goodness! So they're buying stocks. Really, they're kind of equities, and they charge a small fortune. They're incredibly volatile.
I think you can call that a large fortune, by the way, not a small fortune.
Yeah, that is a large fortune. Wow.
Yeah.
How can they justify these?
How about just buying a nice total bond market fund? You could get Rare View's Dynamic Fixed Income ETF, RDFI, and pay 4.23% a year versus, by the way, if you want the Vanguard Total Bond, you pay 0.03. Wow.
Okay, let's see, 4.46, and let's see how that portfolio differs from Vanguard's. Rare View. Yeah, you pay a lot for that Rare View. Oh my gosh, the quality of their portfolio is horrible.
How much money, just out of curiosity?
They do not deserve that fee. They are first a fund of funds.
They are. Okay, I was wondering. I kind of figured it might be.
They go out, they own 39 other mutual funds. Morgan Stanley Emerging Markets Domestic Debt, Western Assets. So they're an emerging markets debt fund, but they don't manage the money themselves. They get paid a fortune to pay other people to manage the money. That's nice work if you could get it.
Yeah, it is.
I don't really do anything. I make 4.5%, and I just make other people manage the money for me.
Didn't they have a feeder fund that Bernie Madoff, that gave money to Bernie Madoff? And then there's a company that we know. I actually met the president once. ProShares. I don't think he's there anymore.
Yeah,
ProShares global listed
expensive.
Private equity ETF, PEX, that you're paying almost 3% a year, 2.95%.
Wait a minute. By comparison, that's dirt cheap.
It is. Or, well, since you mentioned dirt, if you want to get in the dirt and get some agricultural commodities, you can own the Tercrium Corn Fund, be careful the way you say that, Corn Fund, CORN, and only pay 2.71% a year.
Oh, well, they're just getting cheaper and cheaper.
Mere nothing. And then, of course, there's the 2X Bitcoin Strategy ETF. I'm sure there's more than one of these. BITX. I think we've talked about BITX.
We have talked about BITX.
2.38. I bet BITX has had some couple pretty rough times here between now and last October, too, on top of paying that ridiculous fee.
Well, I want to thank you for starting us out high because it made those others just look so reasonable by comparison.
You're right.
How in the world can any mutual fund company justify? I have a problem with two. How do you justify two? But my gosh, how do you justify 14.6?
Did you look up and see how? Yeah, it was 14.19. Did you see how much money was in that fund? I mentioned to do that.
No,
ORR.
I need to look at that. What was the symbol again?
ORR. Or not. Or
something.
Go away.
Why do they call it the Militia long-short equity?
Because they're on the march.
Okay, wait. See, they don't have slouch assets.
How much?
I mean,
$200 million.
It's a 1-year-old fund, and they have $300 million.
Okay, so somebody likes.
So they're making.
Something.
Wait a minute. Let's.
That you can run that number pretty easily.
I can run that number really easily. I can figure out what I did with my calculator. So we got 300. 0.14 is $420,000 a year.
No, that's low.
I mean, $4.2 million a year.
$4.2 million, yeah.
$4.2 million a year.
Yeah.
I left a couple of zeros.
Good work, as you said, if you can find it. Why not?
So they get.
Okay, that was just to open or shock you a little bit. Let's get more realistic because you're listening because you're an index-funded investor or you're a factor fund investor. Let's talk about some of the funds that we talk about here and try and give you a little comparison. Now, you mentioned Vanguard. The Vanguard Total World Fund. You can now get that for 0.06, 0.06%, and you own the globe. I mean, you talk about the age of investors truly is. Or if you want to own bonds and a total bond fund, the BND is now 0.03, 0.03. Absolutely low. By the way, our average for the funds that we use for our clients, I just looked it up, 0.16. How come? Why are you paying so much more, Tom? Well, we'll talk about that in just a moment. Because I also want to mention VOO, the Vanguard S&P 500, which I think is the biggest exchange-traded fund in the world, 0.03. So let's unpack a little bit of just this discussion that does come up from time to time, and that is using pure indexes or using factor-based funds because, yes, we pay a little bit more because some of the things that we are investing in are more expensive, right, that are operated by fund families like Dimensional and Avantis. So, and you already know these numbers, Don, but Avantis has a global equity fund, the AVGE, which is 0.23, quite a bit more expensive than the Vanguard Total World at 0.06. And Dimensional has a all equity fund, global as well, DFAW 0.25. So why would we pay more for those than just the index? That's
because they're more complicated to operate.
Yeah,
they're applying some rules. They're buying stocks that are smaller. There's a management. They're not active, but there's a management component to it that does not exist with an index. An index just blindly buys everything in the index. These rules-based products apply rules and then exclude or include based on the parameters that these rules set for them.
And
right?
They're more expensive to operate. Well, yeah. And
because they're more expensive. For that reason, they're more expensive to operate.
They don't just mimic an index.
You have to have somebody making the rules and then applying the rules.
That's right. And it is active to a degree. In fact, I think if Dimensional would prefer to be called active rather than index because they don't want to be known as just holding this group of stocks that somebody's come up with. These are their own rules. The academics have gone back and looked and said, well, we have made a little bit more by investing more in more profitable companies or really value-oriented companies or whatever part of the market that they can look back in some cases 100 years and say that's been more productive than just owning the S&P 500. So those are important things to consider. But in the big picture, here's the thing I try to remind people about expense ratios. If you're paying anything over, I would say, 35 basis points, and you want a portfolio that's designed to be passive or rules-based, you're paying too much. And here's a way to look at it. For example, as I said, our average is about 0.16 for the funds that we hold for our clients. If you're paying twice that, think of it. I try to think of it as filling your car up with gas, which I don't do very often anymore because I drive a hybrid. So I go about once a month. But every time you fill up, most people fill up once a week, once every 10 days. That you're paying that twice as much as you have to somebody else, and you're doing it over and over and over and over. And here's the worst part: with mutual funds and ETFs, you never see it. They don't send you a bill. You don't get to pay you don't write a check or anything. That money is just coming out of your account.
14+%, that almost 15% that
Good Lord.
Militia funds gets is not. You don't just see it come out of your account.
There's an army of accountants that have all this figured out.
Would you like to know more about the Militia funds?
Yeah, please do. But anyways, you get the point. This is something to pay closer attention to, and it's something that we talk about fairly regularly, but I still see people with bad portfolios where they're way overpaying. But yes, please tell us about the marches on.
The website basically looks like a Word document. It really does.
And they still have raised $300 million. It just shows you.
Here's why. You're going to love this story, okay? I'm reading directly from his online website Word document. 1, me. My name is David Orr, and I'm 39 years old.
That's the ORR part of the ticker. Got it.
I have degrees in accounting and economics.
Well, there you go.
I grew up in Oregon, spent a decade living in Thailand, and now I'm living in Osaka, Japan, so that I can study Japanese investments. In Thailand, I supported myself playing internet poker. By 2016, I had played 10 million hands and was a top 50 player in the world at No Limit Texas Hold'em. I love strategy games, particularly ones of imperfect information, and have neared the top in a couple besides poker. For example, in the card game Hearthstone, I reached rank 40 in North America and out of a player pool of millions. When I was 15, I got rich in the game Diablo 2 by market making in chat rooms. I play Civilization on the hardest difficulty. The stock market is the best strategy game I've ever played. I'm married and will start a family this year. Anyway, he's also a finfluencer.
Oh, of course he is.
He's got millions of followers on TikTok and YouTube.
And what's he advocating right now, I wonder?
Shall I look at his strategy?
I'd just be curious to know, because if he's moving money around with his $300 million, what's he
well,
piling
what he does,
into?
Here's how it works. His strategy exploits two market anomalies. First, less volatile stocks have higher returns. And second, small stocks have higher returns. So he's doing a small tilt.
Okay, we buy the small cap thing, but the first part, less volatile stocks have higher returns?
I've run 200% long and 100% short on average.
Oh, okay.
So he goes long, short.
Levering up, yeah. Okay.
Levering up. Anyway, he's trying to beat the market, but the problem is he's got no public track record.
Well, he does now, because he moved right to the top. He's the most expensive ETF in the world, from what I can find.
That track record, but
you're moving right to number one, Mr. Orr.
His ETF has been around for just about a year. I wonder if how much the return. Do we have a 1-year return for ORR? Come on, Morningstar. I need you to work for me. There we go. Performance is coming up very slowly because for some reason Morningstar's database. Oh, here we go. Okay, growth of $10,000. I broke the computer.
It was so big that it just melted down right in front of you?
I broke the computer.
All right. Well, we tried. ORR.
Maybe I'll get it someday. Maybe Morningstar's numbers will come up, but they haven't been around very long. And my gosh, I got to tell you, That young man is very greedy at that expense ratio. Very, very greedy. I don't understand why you have to be pretty stupid to invest with him. I'm sorry. I just want to come right out and say that. You got to be pretty dumb to give anybody who charges that kind of expense ratio money, because the amount you have to make to even break even is ludicrous. It's not normal.
Yeah, it's way outside of that. So fair enough.
Got questions?
Right. Yeah, lots of them. Keep them coming to talkingrealmoney.com. Happy to discuss. And sometimes, by the way, somebody sends me very lengthy, 1,000 words, and I call you up and I chat it out rather than trying to do it here. So this is one of them, but it comes from Wooster, Ohio. Arden writes, in my combined traditional IRA and Roth IRA, my equities are VT and AVGE, which I think we just mentioned, in approximately equal percentages. This results in a 65-35 split between the U.S. and the rest of the world, which is about where we are, by the way. I'd like to increase my rest of the world percentage by 5 to 10% while keeping the balance in AVGE and VT. Do you have a suggestion for what ETF to use? I'll soon be 80. Purpose of this investment is to let my children inherit them to boost their retirements. So he wants to increase his global exposure. I say global, his international exposure, pardon me.
Which I can't argue with.
Which is fine. But the question is how to do that in his IRA and his Roth. Now, obviously, anything you do inside a IRA and a Roth, no tax consequence. So you could make any move you wanted to. Yeah. If you wanted to keep it simple, I don't know where you go. That's going to have more of a value tilt to it.
Yeah.
But is it going to increase the international exposure?
Well, AVDE is just international.
Oh, that's correct. Yeah, but so you have to add a certain percentage of that.
Yeah. Just buy some AVDE.
Maybe one third.
Yeah.
That will increase the international exposure.
And that'll get you to 50-50 U.S. international.
Yeah. So there you go.
Which I like.
Don
I
likes.
think is good.
Yep. Okay, here's a question that came up a couple of times this week, so I'm going to apologize in advance for any confusion that we may have caused, because Richard writes us from New Milford, Connecticut. Hi, Don and Tom. I left the January 23rd podcast with Tom and Roxy a bit confused. The last question involved an elderly couple who were going to inherit $300,000 they didn't need. It was said that you wouldn't want to have money in one fund in the brokerage account. I've heard Don mention in the past he likes the idea of having all his brokerage money in one fund of funds because there's no rebalancing needed and therefore no tax consequences. Can you clarify?
Well, there are tax consequences. I don't think I ever said no tax consequences, just the fact that it's easier. That's all.
It is easier. I think what we were talking about, Richard, and this is a fair question, is if you ever have to do any rebalancing, doing it with one fund is impossible, right? Because the one fund is doing that for you. If you have a certain type of asset class or some stocks, some bonds or whatever, you're able to sell and buy things. There are going to be taxes, but it'll allow you to rebuild the portfolio that way. That's the best I could think of. I tried to go back and find the question on the podcast and was unable to do so. And I asked Roxy, because she's younger and she doesn't have the 10-second rule. She remembers more quickly than I did. And she said, I think it was because I wanted people to have more than one thing in the fund to be able to buy or sell something to rebalance the account.
To my belief, I mean, if you have like a target date fund or a fund of funds that is in the right mix, you've got a balanced fund of funds or something. They do the rebalancing for you.
It's all set. That's right.
So you don't have to. So it's not. There's no confusion. It's just depends on the kind of portfolio you have. If you want a portfolio where you rebalance, then yeah, you need multiple funds or you can't.
That's a good point. It's a good point.
That's it.
All right. We got time for one more here from Virginia Beach, Virginia.
Oh, yeah. Wow.
James.
That's a lot of Virginia Beach, Virginia this week.
Yeah. Love it. I'm curious why Dimensional and Avantis, those are two fund families we talk about frequently, who are typically so evidence-based, even have investments such as mid-cap. Hasn't tilting toward mid-cap not shown to give any edge? Also, they have REIT investments and bond investments. Does their evidence-based approach also apply to these? I often hear you recommend their stock ETF mutual funds, but not hear much on the other assets. In fact, I think I heard you talk on a Friday about their bond portfolios.
I got the answer on this one.
Oh, please.
I know this one. They're not saying overweight mid. They're not saying overweight mid. They have mid-cap funds to give you, if you have individual funds, you have a large growth and a large small and, a large value and small growth and small value, and so that you can add mid-cap to the portfolio. And if you look at their own portfolio, and let me get the latest numbers so I have the latest stuff. If we go to AVGE, which, by the way, is a fund of funds.
Yep. It's
Vanguard
globally diversified.
Global
It's
All
going to
Equity Fund.
have some mid-cap in it.
It has,
anyway.
right.
Yeah.
It has a little less than 3% last I looked. And let me just double check. 1.3. So 2.8% of the AVGE portfolio is in two mid-cap funds. Whereas I'm talking about U.S. mid-cap. They don't even have a mid-cap international. So, whereas in total small cap, both U.S. and international, they have about almost 10%.
Yeah, let's talk about that for a minute.
So they're dramatically overweighting
Thank
small,
you.
and they're just giving you the market's share of value.
Thank you.
I mean, of mid.
Yeah, mid-cap, the action, frankly, if you look back, has been more on the outsides, larger and smaller companies. So they focus on those areas rather than mid-cap, but you do own them. Now, back to the bonds for a moment. The answer to your question there basically is no. The evidence-based approach, we would prefer with your bonds to just have a widely diversified bond portfolio with a few changes in it, but really watch the cost there. I think we'd be looking at that more than evidence-based per se.
Well, no, but let me give you an evidence-based answer.
Please.
You own bonds and you own real estate in addition to equities because the evidence shows that these tend not to move in lockstep. That's the evidence-based approach. It is the diversification that they bring through non-correlation or lack of correlation. There is not direct correlation. Bonds tend to move slightly differently than stocks move. Real estate tends to move slightly differently than stocks and bonds move. So what you are getting is this lack of direct correlation so that the volatility of the entire portfolio is reduced. That is actually an evidence-based approach, but it's not saying real estate is going to outperform stocks. It's just saying we want to steady the ride.
Yeah, but my recollection on the fund usage, either Avantis or Dimensional, has been those specifically have been used for a specific type of stocks, not necessarily fixed income nor REITs, because if I remember last time we used REITs, I think we used a Vanguard REIT fund. You correct me if I'm wrong. Oh, no, we used the Dimensional REIT fund for a period of time.
Yeah, we did. Yeah. And for example, in AVGE, just under 3% of the portfolio, this tells you a lot. Just under 3% is in real estate.
Real estate investment trust.
Just under 3% is in mid-cap.
Yep.
So it's just having full market exposure. That's what they're going for. But their overweighting is hugely overweighted by comparison to small and value.
Yep.
Big overweight to those because that's where the bulk of the evidence shows outsized returns.
Yep, exactly.
Potentially outsized returns.
Yeah, a couple things coming up that you should be aware of very soon, and you can only join us virtually now at Retire Meet 2026. We've got a great group of people coming to speak, and the signups have been strong. But we'd love to have you join us virtually. People do it all the time. And by the way, when Don gets up to speak, yes, you can hit the mute. You don't have to listen to what he says. You can just look at him up there on the stage. It's very simple to do. I was going to pause there for you to say something.
Not commenting.
Okay, retiremeet.com.
Not going to give you the pleasure of a response.
I wish you did, because I was really looking forward to it. Retiremeet.com for that. And
I've learned to ignore you now.
If you'd like to have a one-on-one with yours truly, down in Scottsdale, Arizona on the 7th of April, I will be I have a few meetings, taking a few more. You can just go to talkingrealmoney.com, click on Meet an Advisor, and say, I want to meet with Tom in the desert. Well,
and
remember,
remember to bring some earplugs when you meet with Tom. It's a little loud.
See, you get a rise out of me, you don't get one out of you, but that's just the way the world works. So take advantage of all that stuff. We want to help you.
Go to talkingrealmoney.com. And it's named that there's a reason for it being named talkingrealmoney.com because right here on this podcast, we're talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.